U.S. equities up at 55% of global index market cap, world market cap. They got there through globalization. And that's a very high level, and there's a lot of profits moving cross-border, and a lot of these things are at risk. Now, again, if this is all resolved quickly, we have a sound economy. We could rebound from this. We want to be very careful here that when you build up a lot of anxiety about these issues, sometimes there can be roaring rebounds if these things come into the play.
We are not just jeopardizing the growth today, we are jeopardizing future growth, and that is playing with fire. So I think the expectation the market still has, if I had told you 3 months ago that we will have a full-fledged trade war and the markets would be down 5-6%, I don't think you would have believed that. And I think what that is telling you is the fact that markets are still expecting that we'll reach some sort of a resolution.
If it is so important for us to be independent of China, and I can see the case that that would be true, then we have to develop our own supply chains. We have to actually radically increase the rate of investments, in manufacturing. You'd have to do it in ways that work economically. And at the moment, I don't see anybody even talking about that. I think we're essentially dependent on China without a plan B. And given the current politics, that strategy in my mind is, just asking for trouble.
I like the broad tech space. I mean, if we do get an escalation of trade tensions, then those names that have heretofore been unaffected will take a leg down. And if, in fact, this impasse is temporary in nature, if Huawei and President Trump's escalation with regard to Huawei is a negotiating tactic, which I think we all kind of know the president's playbook, right? I mean, it more likely than not is, then I would take an additional look to those sectors that are the most adversely impacted because they haven't been affected by tariffs yet, which are tech.
Beyond that, I think we all need to pause a second. There's not going to be a 25% increase in the cost of all these items. And the reason is because there are alternative sources and companies have been working on this for a long time. It really should be just a single digit, increase, low single digits over time, because obviously they're in China because it's the best place to be there. But you have the rest of Southeast Asia, Vietnam, Indonesia, Bangladesh. You have India, you have North Africa, you have Eastern Europe. You have plenty of places to go as alternative sources apply for most of these products. And that's what the big and smart retailers have been working on and will work on a lot more.
The issue is the actual escalation, the turning of the heat further to the 25% on the remaining $300 billion. That's actually a very strong fire that would be burning. And that's not just for China or for the other economies that trade with China, like Europe, like Japan, like the rest of EM Asia, but it's also an issue for the US economy, and that probability has gone up. So what we've really been advising clients at this point is make sure their portfolios are right-sized, that there's more of a neutral balance between equities and bonds. Within the equity side, that maybe there's a better balance between growth and value, maybe some hedges for downside protection, maybe a little bit more of a U.S. focus now than we had thought before, maybe even just 2 weeks ago, and on the bond side that there's Treasury for protection.
This is pretty aggressive escalation that's going to be harder and harder to walk back. Yes, it does make more of an incentive to create a deal, but at the same time, you see both sides really digging their heels in. And the longer this goes on, the more companies have to reorient their supply chains and sales processes. So it's going to be harder to unwind what they're doing now if this goes on longer.
The threat of tariffs couldn't get you over the finish line. And now, from the U.S. perspective, you're going to see if the pain of higher tariff rates bring the Chinese back to the negotiating table. That's going to take a while. It introduces volatility, but we don't think it gets you back anywhere near the December 24th lows.
If we just kind of rewind to last year, when we started to see the trade war sort of pop up as an issue for investors, you saw drops in consumer confidence, you saw drops in the PMIs globally, also in the United States. I think that's likely to continue. That doesn't always translate into persistent economic weakness, but it is correlated with what the market does.